Squirrel Macro the Pod, our usual companion to the weekly newsletter. Squirrel coming to you on the morning of Monday the 9th of December, Melbourne time. The usual reminder to make sure that you get the show notes for charts and all those links, and if you don't have them, fix that right now by signing up for free at blindsquirrelmacro.com. First up, everything in this podcast is for educational and entertainment purposes only and is categorically not investment advice. Before making any investment decisions, for heaven's sakes, don't listen to a cartoon rodent. Talk to a financial advisor. Just before we dive into the world of emerging market dividend stocks, a quick plug for where you can get a little bit more squirrel in the media. Last Wednesday, I was delighted to be included by Team Grizzle in Toronto to join their great lineup of corporates and analysts at their annual Commodity One-on-One conference. I'm also going to be joining Maggie Lake on her Talking Markets show after the US close this coming Wednesday, the 11th of December. There's a link to both shows and how to get onto them in the show notes. Now back to regular programming, where we are clipping emerging divvies. So it looks like we're firmly in the chase phase of the 2024 equity market. The plentiful distractions in the form of new Bitcoin highs, the return of Roaring Kitty, and I guess the inevitable rug pull that was the hawk to our coin. If you don't know what I'm talking about, don't bother asking. All of this nonsense is disguising the reality that the sector rotation into small caps triggered by the election results has now been fully reversed. If you look at the Russell 2000 small cap index versus the Nasdaq, we've gone from overbought for pretty much all of November to oversold by the end of the first week of December. Quite a ride. Last week in Is Santa Getting Over His Skis, we marvelled at how the S&P 500 had just delivered its 7th best month in 4 years, i.e. since COVID, without a contribution from the major market generals. Well, for the first week of December, the Magnificent Seven responded in style with a resounding hold my beer, tacking on a cool $935 billion of market cap in 5 trading days. Actively managed institutional money, staring down the barrel of yet another year of existential underperformance versus the machines, are responding in the only way they know how, pressing the historical winners and hard. For listeners not dealing with the tyranny of annual benchmarking, it feels like a good idea or good time to watch from the sidelines. The air feels pretty thin up here. This week, the squirrel wants to draw your attention instead once again overseas. With headlines dominated by political vacuums in France and Germany and an amateur hour coup in Seoul, did it not strike you as slightly odd last week that the rampaging dollar index was basically unchanged on the week? Reading between the lines of the very mixed economic messaging coming from the incoming Trump administration, it seems pretty clear that most of their primary policy objectives are best achieved with a weaker dollar. Even if the new cabinet's not being explicit about it, it appears that the FX market is starting to listen. In a weaker dollar regime, we're going to want to hunt down short-duration foreign assets. I was on the phone last week with an old fund manager buddy in Hong Kong. OB, as we'll call him, was pretty despondent. The vocal China bears are once again out in force after the late chasers of October's David Tepper China equity mini-boom are now nursing their rapid told-you-so drawdown wounds. OB is president of an excellent long-only Asian equity shop. As such, much of his non-investing day job involves talking to current and potential investors for his fund, that then unfortunately go on to spend the rest of their day listening to the asset allocation consultants and the rest of the pundit class in the City of London and Midtown Manhattan. From these talking heads, the mantra continues to be that Chinese assets are still basically uninvestable and only a short-term beta trade at the best of times. The trouble with that "I told you so" China drawdown narrative is that its only real victims appear to be in those unfortunate traders that rushed into the most obvious China tech ADR names when they were massively extended to the upside over the October Golden Week holiday, by the way, during which time mainland bourses were closed, providing no local price discovery mechanism. Well done, fellas. Raising money for a China fund may be tough, but Obi is actually pretty happy with his China investments, as is the squirrel for that matter. Even after the latest pullback, the MSCI China has returned 32.6% for the year in dollar terms. This is 1.7% better than the total return for the Mag 7 laden S&P 500. In August, in year-long China anyway, the squirrel observed that a US index with Apple and Nvidia at the top of it was hardly free of China-related geopolitical risk. It's ironic that those two stocks, i.e. Apple and Nvidia alone, account for over 1/4 of the S&P's year-to-date nearly 31% return. While Obi and I have both got some exposure to the big China tech names, there's been significantly greater breadth to the rally in Chinese equities in 24, and the shorter duration value factor has been delivering appreciably better returns in the Orient than the Western value complex has. What is interesting is that some of the best returns in the market have been clustered among the MSCI China's most boring low beta plays. Some of the easiest trades to stay in are the ones that do not cast you aside with volatility, and there's some great illustration of this in the notes with some charts this week. As such, it did not surprise this rodent to read on Friday that one of the best performing, and he's up 66% on the year, domestic fund managers in Hong Kong has been focused primarily on the Hong Kong listed 8 shares of Chinese state-owned entities, or SOEs. In April, China's State Council, which is the top governing body, launched the 9-measure plan of market reforms to impose greater capital allocation discipline on listed companies. The CSRC, the securities regulator, and the Shanghai and Shenzhen exchanges also implemented new guidance on buybacks, minimum payout ratios, and advice on dividend frequency. Now, this was largely dismissed in the skeptical West as a Me Too measure aiming to mimic similar corporate governance policies seen in Japan and Korea, and designed primarily to juice up local investor confidence. The squirrel thinks that this cynicism is slightly misplaced. China's tech giants were certainly very quick to copy the strategies of their US peers with big convertible bond-funded buybacks. Furthermore, in a world in which investments are driven by marginal flows, this buyback trend could really provide a significant boost to market returns in Chinese equities. There's also certainly plenty of scope for Chinese corporates to ratchet up their dividend payout ratios, which are already very well covered with free cash flow. Price-stimulative buyback and dividend activity is part of a package that regulators are seeking to use to lure some of the nearly $10 trillion of net household savings that currently sit in very low yielding bank deposits on the mainland. Local bank deposit rates have been sub 1% for over 20 years and are currently around about 35 basis points. Meanwhile, the MSCI China offers a trailing 12-month dividend yield of 2.25%, underpinned by free cash flow yields of nearly 7%. This starts to look pretty attractive for those in the hunt for yield, and yes, I do know that a dividend is not a coupon. In the chart pack, I've plotted the total returns of the MSCI China constituents against their dividend payout ratios. The regression line could, of course, always be a bit steeper, but the market does appear to be rewarding the stocks with the largest payout ratios. And you can see that pretty clearly in the data. Then let us not forget that ultimately Chinese, as well as other North Asian investors, are momentum investors at heart. If the local equity market really starts to look like it's back in a long-term uptrend, further buyers are going to emerge from the sidelines, including those Chinese exporters that are currently hoarding many hundreds of billions of dollars offshore and probably hanging out in the Nasdaq. Then consider the impact of China's increasing ability to pay for her imports, especially oil, in her own currency. This is up almost 27% in the first 8 months of 2024, according to the PBOC, the People's Bank of China. A scenario in which Gulf energy exporters elect to recycle an increasing share of their renminbi proceeds from their energy exports into Chinese financial assets does not seem fanciful were the market to become more of a success story. Finally, the squirrel is well aware that valuation is never a catalyst alone. However, it would be churlish not to observe that the margin for error on the value front is now pretty compelling. Plenty of the MSCI China's constituents offer single-digit P's with near double-digit dividend yields. Now, regular listeners will know that we've already got plenty of China-related exposure in the Acorn portfolio. Probably enough, to be honest. However, in Section 2 of the paid letter this week, the squirrel revisits an alternative exposure. It's an old friend that benefits from many similar themes to those outlined around China above, but comes with further diversification benefits. I think it is a position that can act as a core component of that short duration non-USD allocation that this rodent believes will serve investor portfolios well over the next few years. Find out more about it at blindsquirrelmacro.com. You can also find me on Twitter at squirrelmacro and Blue Sky at blindsquirrel. Thanks again for listening. Please don't forget to spread the word. Squirrel out.